point out is that Richard Swart will be here until 11:15, so make sure that you catch him during the networking break. If you don't, I will have some of his business cards for you. Our next speaker is, has been mentioned by several people this morning, is Ron Suber, President of Prosper. Today marks Ron's 48th presentation this year alone on marketplace lending. He will be sharing his thoughts, observations, and experiences on where we are going, why, and the benefits to all of us. Please welcome the President of Prosper, the fastest growing platform in the world, and the turnaround of the year in Silicon Valley, Ron Prosper.
Run to prosper.
So I'm going to stay right here and really shake things up a little bit and have this open conversation and go through this presentation. My goals are that when everybody leaves here, that they really understand what's happening and why it's happening and how it's happening and how fast it's happening and how it's so early and how you can get involved and you can make money and understand what's happening to your customers and your potential customers. And one of the things that's different about my presentation, as Mark said, is I don't use PowerPoint either. I'm all about Prezi. And you'll see Prezi today in a little different way in the presentation. The other thing I would really like to do is take questions at any time. So if anybody has a question, please raise your hand. The goal here is not just to talk about what's happening, but it's about education and awareness and understanding. Because the more we grow this industry with best practices, with what Richard talked about this morning and Mark, the better this whole thing can be. So let's start off with going backwards in time and take a look at, very quickly, the history and the innovation of transportation on this planet and compare it to what's happening with this collision of Wall Street and Silicon Valley and the banking industry with how we pay for things and how we borrow money and how we invest and spend. It's right in front of us and it's happening right now. So if we go back a long, long time ago, this is what transportation looked like. And over thousands of years and millions of years, it went to this. So this planet was dominated, transportation-wise, by people who had horses for hundreds of years and thousands of years, until the people with horses saw this thing. And the people with horses were the incumbents, and they said, no, people don't want this train thing, because it only goes in a straight line. They want faster horses, or taller horses, or different colored horses. But they didn't understand, as the incumbents, this wasn't a fad, this wasn't a trend, this was the new way of transportation. And so think about the banks and the credit card companies. I'm not an anti-bank credit card, but they are holding on to what they know and starting to now realize what's happening here. What Mark talked about with equity and debt crowdfunding is here, and people are telling us they want something different. Then the car came. The train people didn't realize that what happens in cars and the way people use cars was also changing with transporting goods, and then trucks came. And this is what the banking industry is realizing, the credit card companies with Apple Pay and Alibaba, and what's happening here, it's really big. It's as big as transportation changed, money's changing. And then this came, and now this is here, and now this is coming, driverless cars. This is how big and how real what we are doing here together. So now let's talk about your customers today and our customers today. This is what they used to live like. This is what the consumer experience was. For 30 years, we had a thermostat that never changed. We had phones that just made phone calls. We had 10-pound, $5,000 laptops with short battery life and short storage. And we waited in line for taxis, and we put ads in newspapers on Wednesday to hopefully sell it on Sunday. And then it changed. Technology and Wall Street and banking all got together to start changing the consumer. And what we're doing is just adopting to what the consumer's looking for. A different way to borrow and a different way to lend. My children don't buy music the way I did. They're 20 and 21, and when I say, look at this CD I paid $25 for that's got 12 songs and I just like one, they don't want that. They wouldn't even think of doing that. Never will have a landline, these kids, this next generation, and they would never call an airline to book a trip. It's different. And that's what we're doing at Prosper. We're giving people a different way to borrow and invest, and we're going to go through that so everyone's clear. Why did Prosper go from $9 million a month of originating loans a year ago to $172 million last month? It took Prosper 8 years to, in aggregate, do $1 billion of loans. It took 7.5 months to do the second billion. That's how fast this is changing. We'll do $1.7 billion this year. We did more in the second quarter this year than we did all of last year. That's how fast this is changing. It's because this consumer wants to borrow and invest in a different way. And this consumer has said to us, I don't want to put on a suit and go to the bank. I don't want to use that institution my parents did. I'm comfortable with eBay, Apple, Amazon, Facebook, Alibaba. And I love this marketplace lending concept of people and people. It's different. It's fast. And it's not just in finance. It's how we pay, how we shop, how we travel, how we store data. It's changing, and it's changing so fast. So this is not something coming next year. This is not something in the future. It's today. And we're really excited because it's truly the first inning. That everything we did before today was just practice for what's coming, as long as we're best practice and we keep our standards right and we make sure we work with the regulators. So at Prosper, we're SEC registered. Every time we have a borrower and we put them in the fractional pool, we file a prospectus and send it to the SEC. We report as if we're a public company. We register with all the states. Every state we're in. What are the laws? What are the maximums? What are the terms? What are the things you care about? So SEC registration, state registration, and we work with the other regulators. Let's take a minute and talk about exactly what's happening. So now you understand kind of why this is happening, because we're adjusting the consumer, major transformation in how we borrow, lend, invest, and pay. Let's really get into what happens in a marketplace lending situation like Prosper. So let's divide the room in half. This side will be the borrowers, and this side will be the lenders or the investors. So we have three types of borrowers. We have people with credit card debt. The second group are people that want to buy something, home improvement, special occasion, medical procedure, auto, taxes. You get the idea. It's a transaction for something, wedding ring, it could be anything. And the last group are individuals who are entrepreneurs in our country who want to borrow money for their business but can't get a business loan, or can get a business loan but the rate's too high. So debt consolidation, I want to buy something, and I'm an entrepreneur. And this side of the room is one of three types of investor. The front group are retail people like us who are looking for yield. The 10-year U.S. Treasury bond yields 2.1% this morning. These platforms yield 7%. So you can see why there's this interest in yield. This middle group are institutions, the biggest asset managers, BlackRock on down, the biggest hedge funds, pension funds, sovereign wealth funds, insurance companies. You get the idea. And the last group are the banks. We're working very closely with the banks. We're still small, but they're all calling us to say, hey, how do we work together? So that back group are the banks who are lending money on the balance sheet. So what do? We try to tell our story. We try to find people who have credit card debt, who want to buy something and have a business. And we use firms like LendingTree, who you're going to hear from next, about how they're trying to help Americans with credit education and getting the right amount of money at the right price. We find these people by sending out 5 million pieces of mail, digital marketing, and all kind of partnerships with firms like LendingTree. And we rate and rank each of these people. We have 500 pieces of data on Richard the borrower. We know more about Richard than he ever thought. And we give him a letter, AA, A, B, C, D, E, or HR, kind of higher rate, higher risk. We give him an offer for credit of a 3-year loan or a 5-year loan, and a rate. Richard says, yes, I want to do it. We start validating and verifying who is he, what's his identity, is he real, income, employment, and all this other stuff. And at the same time, we go to this group saying, hey, guess what? We've got an A or a B or a C. He wants $10,000 for 3 years or 5 years. Anybody interested? And all these people over here on this side of the room start bidding to invest in Richard. So like Uber, the largest transportation company in the world that doesn't own a car, like Airbnb, the largest hotel company in the world that doesn't own a hotel room, we're doing the same thing. It's about trust and transparency. It's about no hidden fees. It's about this experience in helping Richard understand there's a better way to borrow. That credit card he used was a great way to buy something, but a terrible place to borrow money. Banks stopped giving loans, not all of them. They just started handing out credit cards. It was easier. And the rates haven't changed. They're still really, really high. So we validated Richard. We know who he is. We got all his data. He said he was getting married. We checked on Facebook and all these places to make sure he was really getting married. We've got the data. We've got the money. 2 days later, 3 days later, the money is in his checking account. And he can now go pay off his credit card, 36 equal payments on a 3-year loan, 60 on a 5-year. This person or this group of investors is now getting payments every month. So they got more yield than they were getting on their cash. And this person now has less interest payment. Or the middle group of borrowers can now go buy a vacation, a wedding ring, home improvement, etc. And the group in the back, that entrepreneur, now keeps unemployment low because they have money for their business. That is what peer-to-peer finance is. That's what marketplace lending is. In the example I gave you, Prosper, we just do people, consumers with debt or want to buy something. There are other platforms, small business loans, real estate, student loans, mortgages, and next will be insurance. So you see what's happening. We're saying to the world, you don't have to go to Wall Street and buy packaged products. You don't have to go to these incumbents to do what you do any longer. The concept of the collision of Wall Street and banking in Silicon Valley for the very first time are creating these marketplaces, these exchanges for credit. So we have exchanges where you can go buy stocks or bonds or futures, all that stuff, commodities. We now have exchanges for credit like Prosper, like Lending Club, like SoFi, like Realty Mogul, and these other groups that are coming, not just here, but around the world. Big in Asia, big in the UK, starting to be big in Latin America and South America. The future is, close your eyes, a site where you go, like Priceline or Kayak or Expedia, and you can disintermediate the banks and say, I want to borrow or lend across these countries, across these asset classes, in a marketplace. Think like eBay, right? That's where this is going. This concept of going to these high-tech ATMs is over. That's just a place where you can deposit a check, deposit cash, or get money. You can't borrow or lend on these things that haven't changed in 20 years. But what we're doing here is we're creating something different. We're creating something that benefits everybody. And that's what this is about. It's about remembering the benefits to both sides in an honest, transparent way, like Uber and Airbnb. Once you come to us, the marketplace lenders, as long as we keep best practices, you don't go back. When you do an Uber, you don't go back to a taxi. It's a different experience. And it's mobile. So we're staying in communication with people saying, congratulations, you're paying down your loan. Would you like to do more? Would you like to do less? How can we help you? If you go to our Facebook page and see what our borrowers and our lender investors are saying, it's very, very different than you'll see at a bank. These are our core principles. How do we make sure we focus on the benefits to the borrowers? And it's easy. Frictionless, easy. Take pictures of your taxes, income, all your stuff that we require, and send it to us in your mobile device. Give us access to your bank account so we can go in and learn about you. Fast, easy, low rates, transparent. We're not cross-selling Richard now. Would you like a checking account? Would you like insurance? Would you like a credit card? We're doing one thing. We're just trying to help this person pay less interest, buy something, or help their business. And we're just helping this group get more yield on your cash. No conflicts, with really good customer service. And to the investors, for the first time, this group can now invest in this group because of these marketplaces. They can diversify their risk. This group can say, I'd like to put $25 in 100 loans a month for the next year. And the system will just find these loans. I won't sign in blood, but I will sign today to your challenge that we don't adversely affect the retail group. We will always be retail, and we will always have the same loans, as much as retail loans they can have. When we got to Prosper in January of 13, there were only retail. There were no institutions. And we brought the institutions in to complement retail so that we could spend more money to find more borrowers. You will never see just a retail platform. It doesn't work. That's why every platform has a blend of retail and institutional investors. Our commitment is to this concept of trust, to this concept of this can work. And yes, there are concerns, regulatory concerns, unemployment, interest rates, security breaches. We are very, very focused on all of this. And one of the things you're going to see are Prosper bonds available in the marketplace. So some of the investors on this side of the room have been buying up these Prosper loans and going to the banks and saying, I've got $25 million of this diverse group of paying, yielding investments. Can I borrow money against the $25 million? And some of the banks in this country have said, yes, we'll loan you 50. So that client comes back and says, I bought $25 million, I've got 50 in cash, I want to have 75. So they buy the 50, now they've got 75 million, it's working. They go to a rating agency and says, hey, I've got this pool of loans, can we rate it and rank it? And then securitize it and sell now the different pieces of all these loans to the insurance companies and the largest asset managers and the sovereign wealth funds who didn't come directly to the platform. It's happening, and it's helping, and it's showing people that this is now this brand new institutional asset class. I'd love to take a pause here and see if anybody has any questions about how we, not just Prosper, the marketplace lending industry works across consumer debt, student loans, and real estate, and small business. Yes?
You had mentioned insurance. Can you elaborate a little bit? What would that look like?
So the question is insurance. It's a natural, right? It's happening, it's early. So what happens today? I have a car, I have a home, I have a kid in college. I send this huge check to this insurance agency, and they do something with the money, hoping I never call them. It's a terrible experience. I have a problem, and then it's a really terrible experience. Well, what if there's a marketplace lending where these people with money and these people who need insurance are now connected? And so I pick on Richard. Richard's got a home, Richard's got a car and a kid at college, and I rate and rank his insurance situation. And I put him up into an insurance marketplace, and I go to all these investors saying, I've got this guy who needs some money, he's gonna pay these premiums and returns, I've done the risk, the actuarial tables. he should pay 10, he's paying 15. Does anybody want to invest in Richard? And when Richard has a claim, it comes back. Hold on one second. It's coming. It's not there yet, but it's another incumbent financial services industry that hasn't changed in a long, long time. I'm not selling it. I'm not telling you you should do it. But think about it. It's happening in mortgages. To get a mortgage is an awful experience. It's already in Taiwan. It's already here with SoFi. They did $30 million last month alone. So think about mortgages. Same kind of thing. If you don't believe insurance, then you probably don't believe it's happening in mortgages, but it is. Yes?
So that's the Lloyd's model with the names. That's how they underwrite the insurance. Is Prosper going to do that?
Is Prosper doing insurance? We have no announcements today about our insurance. And yes, there was a lot of other questions. Yes?
Yes, John Brewer, Competitive Enterprise, speaking tomorrow. Great presentation. I wanted to ask, you said you were registered as if you were a public, and filed the SEC as if you were a public company. As I understand it, and correct me if I'm wrong, you have to register every loan with the SEC and with a lot of state securities regulators as if that loan itself were like a public company or a separate securities filing. How much is this costing you in both man hours and compliance that you could be, making other, good loans to good borrowers? And what are some suggestions for just trimming, the red tape, just simplifying it a little bit, when you do the best thing the SEC and Congress could do there?
So in front of my legal counsel over here, I'll just tell you as much as I can. So this is Prosper version 3.0. Prosper version 1.0 was where the investors bid against each other to set the rate and competed to find the borrower. Prosper 2.0 didn't register with the SEC, and neither did Lending Club. And the SEC came to the industry and said, hey guys, these are securities. These are syndicates. These need a prospectus. Lending Club said, no problem, we'll shut down for 5 months and we'll come back and show you, we agree with you, yes sir, you're the government, you always win, we'll do it. The old Prosper guys said, no, we disagree, we're going to fight you. Well, they lost. And in the meantime, this group sued Prosper for $50 million, saying you didn't register, you didn't really validate and verify Richard the borrower, and sued Prosper for $50 million. So there is no question, are these securities in the fractional pool? There is no question, do we have to register with the SEC in the States? It's yes, sir, you said we should do it, we're doing it. So when my partners and I took over Prosper in January of 13, we went to this group and the SEC and we said, we're sorry for the sins of the old Prosper team. We don't have $50 million. How about 10? And they took it. So we wrote a $10 million check to make the SEC happy and all those investors happy and moved on. So the barriers to entry or the moat around this, why it's so hard, is because you need a credit model. You need a marketing team and partners like LendingTree. You need investors. You need the legal team to register SEC, file with the SEC in the States. This is really hard. This is not an easy business. It's a very expensive business. Prosper went through $82 million before we got there. We put in 20, 25, and another 70. We just hit our 5th month of profitability. But it took 8 years and a lot of money. Yes, I'm back.
How do you handle payment?
How do we handle payment defaults? So go to the website and we show you. There's 7 ranks, AA, A, B, C, D, E. There are defaults in every rank and group. If Richard's a AA, he probably pays 5% and he probably defaults a little. And then everybody pays a little more and defaults a little more. And we tell you, if you're going to buy these different groups of people, be aware. The gross rate is this. The expected default is this. We take a little service fee, which I'll talk about in a second, and your net return is going to be this. So your question is, what happens when Richard, an A, AA, A, B, C, D, E, defaults? We call Richard for the first 10 days. Hey, buddy, I see you've been paying for a year, 2 years. Did you move? Did your spouse forget to put the check? New bank account? What happened? A lot of times we can get him, the borrower, back paying. Sometimes we can't. On the 15th day, we say to Richard, we tried really nicely. We've been calling you here from Prosper. We're going to turn you over to a collection agency. And for 110 days or 115 days, they're going to work with you in a little different way. Same as the banks and credit card companies. And on the 120th day, Richard, if you don't pay, I got to tell those investors you're a bad guy, and we're going to report you to the credit rating agencies, FICO, Experian, all those people. The same as if he didn't pay back his bank or credit card. You're shaking your head.
It's a longer conversation.
Yeah, happy to have a conversation. Again, this is all how we do this, why we do this. It's all on our website. It's filed at sec.gov Prosper. It's in our S1, our K, and our Q. It's very, very public how we do this. Yes.
How are you able to take non-accredited investors? And since, you know about Title II, so in your specific registration, obviously you're doing specifically than any of the other platforms.
So how can we take in individuals who aren't accredited is the question? So there's equity crowdfunding and debt crowdfunding. We're debt crowdfunding, so we're not subject to all that title stuff. Not that it's not important. Yeah.
Now, that's not really it. What it is, he's a business guy, you know?
Okay.
But what it is they have publicly registered securities. So when that side of the room invests, they get a note. They call it a platform note. That's a security. But unlike the Realty Mogul and the Fundrisers of the world, their securities are registered with the SEC. They filed a 4,000-page prospectus with the SEC, and every loan they do, they electronically, part of the answer to your question is, it's all electronic, so they file a new filing with the SEC. So it is a publicly registered security. That's why they can sell to non-accredited.
Thank you. It's only the 10th time I've been wrong today. So we make money by charging an origination fee one time up front to this group, called 4% on average. Our average loan is $13,500. Our smallest loan is $2,000. Our biggest loan is $35,000. And we charge a service fee, 1% a year, to this group for doing the collections and doing all the money movements and stuff. So who is our competition? It's not Lending Club. It's not the banks. It's education and awareness and understanding, because no one really knows we're here yet. And our opportunity to be on TV, to have a NASCAR, to have a blimp, to have people understand this is the new way, is the opportunity. So this cartoon really says it all for me. It's about making the pie bigger. It's about having people now understand the opportunity to work with us and set up other platforms and find ways like LendingTree to work with us. I think you're going to find Nicole's presentation really interesting. How they're helping American consumers understand there's a better way, a different way, to improve their FICO score, to improve their personal balance sheet, and come to places like Prosper and Lending Club. So I'm happy to answer any other questions or meet with people after Nicole's up. Yes?
I'm not trying to do a we versus them, but I love the vision that you set out. And then I get scared when Wall Street comes in and now starts securitizing the loan. I mean, I think we've all lived through this story before. And so how do you personally sort of spin working with the dark side?
So the dark side is where I come from. I'm a reformed Wall Street guy. I worked at Bear Stearns for 14 years. So we watched what happens with the mortgage industry and CLOs and CMOs and CDS and all that stuff. So we don't allow these middle group of investors to leverage this more than 1 or 2 to 1. We might let them leverage the AA's a little bit more. So leverage is a killer. The financial engineers from Wall Street came to us and said, hey, we have a great idea. Let's do a synthetic derivative where you can go long your A's and short their B's, and we'll give you a... No. This is about working with individuals, rating and ranking them, finding them money, maybe a little bit of leverage, helping institutions buy this, a little bit levered. That's it. So we get it. We have skin in the game. We're fully invested on this one. We've seen the movie. We're not screwing this one up. Yes.
In your opinion, can you describe why you have some version of the threshold election system where if they don't get 70% or whatever, why you
So this is a great question. When we got to Prosper, if the borrower, Richard, didn't get 100% of his money, we didn't do the loan. And so these people were willing to do it if we raised half the money. And he actually wanted the money if we could get to some number. So we called everybody and said, what's the number? If you're asking for 10,000, what's the number we should set? If we get to that number, it's a go. And so 70% is the number today. If Richard asked for 10, and we get $7,001 from this group, it's a go. So that is the way it works today. And everybody's happy about it. It could be less, we just said that was the right number for now. So this is all about experience, this is all about making it work for everybody, and keeping best practice, and making sure we're ready when interest rates go up if they ever do. What happens when unemployment changes? Our rates are going to need to change. What happens if and when our industry gets an attack and the borrower's data is compromised? How do we react to this? How do we make sure we can be in every state and in other countries and do other things? When we got to Prosper, the maximum loan was $25,000. Now it's $35,000. How do we make sure we grow in a smart way, in a fast way that works for everybody? Yep.
So you talked about securitization, you talked about scoring and ranking at point of origination. Talk to me a little bit about how you're thinking about quantifying the risk and the best practice that you have put out there.
Yeah. So how do we quantify risk and best practice? We're spending a ton of time on the most important part of Prosper, which is PMI 5, which is the Prosper Marketplace Inc. risk model number 5. It was number 3 when we came aboard in January of 13. PMI 6 comes out in January or February. And it's the next version of our ability to price, rate, and rank individuals in this country based on everything going on in their life. Today, in general, when you go to a bank or credit card company, they're not doing that. They're not looking at Richard's individual stuff. They're just putting them in this whole group, this band, within the credit card system, and keeping rates low at the top and high at the bottom, and everyone kind of subsidizes each other because it's their balance sheet. We're not doing that, right? Banks take money from this group, pay them 20 basis points, and then try to figure out how to make a bunch of money over here. They're balance sheet lenders. We're not doing that at all. What we're trying to do is for each person understand how much do they deserve, what's the probability and likelihood that they can and will pay it back based on their income and how much they have already. And then showing that in a transparent way to the side. It's very, very different. So our point is we are hiring the best and brightest machine learning people from the credit card industry. You're smiling about machine learning. It's amazing how we can iterate this PMI 5 to PMI 6 and really, really better understanding what's happening over here.
That's a very interesting point. Does there come, because the holy grail is your credit law. Does there come a point where you've done such a fantastic job at creating that model that that's your business and you just license that model to other people and let them do all the horrible stuff of dealing with borrowers and dealing with lenders and you're just licensing?
So did everybody hear that? That's happening today. We're becoming the Intel chip inside banks. So we have banks and credit unions and all kind of other groups saying, we have these people who want to borrow money. We don't know how to do it. We don't want to do it. We can't make money under $35,000. It takes too long. Can we send you the borrower? You do all your stuff and let us buy the loan once it's done. And that's part of the opportunity to work with the banks here, is to be that Intel chip, to let them see how efficient we are. That's why there will be 40,000 new coffee shops in this country over the next 10 years, because half the bank branches are going to close. We have 88,000 bank branches in this country. They don't work. They're there to cross-sell you on other products. And so we're seeing it already with the banks coming to us saying, we have too much cash. We need to increase the yield on our balance sheet. We want to own consumer debt. We want to do it, but we want you to do the work. And it's happening today. Really good question.
So my follow-up question
Yep.
is, you talked about the consumer space, but we move up to small business loans.
So we don't have an announcement to make about insurance or about small business today. When people say, do we do business loans? We say we help entrepreneurs based on their personal credit for a stated purpose of their business. To us, we could definitely do it. But you know the numbers. We did 67 million in January and 172 last month. We just got to focus on what we're doing and make sure we have best engineering, best practice, and keep it all together. There are new platforms starting. Think about all these smart kids who want to become coders, programmers, engineers, DBAs, quality assurance. They don't have the money to go to school. But there's a guy in this room who's creating a new platform so that all these smart kids in this country can now borrow money, go to coding school, and get jobs. And he's right there about to ask the next question.
Thanks, Ron. I wondered, you mentioned international growth. I wondered how you saw that happen. You think bigger firms will manage to steer a few ships, don't necessarily risk-wise, or do you think it'll be lots of different?
So the question is about international. There's one firm today that's in 2 continents, and that's Funding Circle, and they do small business loans. And a UK firm bought a small US firm and tied it together. It's going to happen. First, we're going to be in every state, right? That'll be done in the next 6 months or so. There are some states that don't let Lending Club and Prosper in yet, but the residents are sending letters saying it's not fair that Michigan can do it, Texas can't, or Rhode Island can't, etc. So once we get to all states, and once we finish building out Prosper, while there's no announcements to make today, I think we will be global at some point. Yeah.
Can a retirement account be a borrower?
I don't think legally retirement accounts can borrow.
They can invest, so we have lots of retirement accounts over here.
No, retirement accounts can be
Yeah,
recourse
oh,
line,
absolutely.
right? So my question is, within Prosper, can a retirement account? be
I don't think so, but I see head Steve. Does anybody have an answer on this?
Yeah, there are certain ways that deferred income can borrow.
Here's the expert.
Yeah, sorry, right here.
Seriously, the
So-
A
expert.
account can borrow money. My question is, can it borrow money?
I don't think so. Do you want to take this one?
Yeah, you know, actually, hi, I'm Jason Triplett, compliance at Pensco. I actually helped Lending Club, Renaud LaPlanche, set up his firm a few years back when I lacked the insight to understand the business model. But the quick answer is yes. You can invest, in fact, I'll be happy to see the after this meeting, but you can, and in fact, it's a very strong area of growth. The finer points of it are discussed in IRS publication 590, but the quick answer is yes, and we'd be more than happy to help you out with that.
I know that an IRA can borrow money, but my question was, can the borrower?
I think the answer is no, but I'll come back to it.
I would think you would have to have a deal with an
Yeah.
alternative asset custodian, which I don't think you.
Sounds like we're going to work with these guys and make it happen. Anybody else? Yeah.
So for your expansion, is that going to be unilateral, or going to be partner, acquisition? How do you see that? You just told me you're going to go global.
Well, we got to get to Texas first. That's kind of another country all by itself, right?
Texas is another.
So what are we doing next? We don't know exactly what we're doing yet. We actually do, but we can't talk about it. Do we go public? Do we sell the whole thing? Do we buy somebody else? Do we just stay the way we are? We have plenty of money, we're profitable. I just got back from a 2-day offsite. I took the red eye to New Orleans, spoke at a conference there, flew back here last night to be here today. We're just trying to get it right. We're trying not to screw it up. We're trying to grow. We're trying to make sure that it works for everybody. We have no announcements today, but we have a lot of stuff going on. And our phone's ringing off the hook from everybody, from the tech firms and the banking firms, asking us or telling us what to do. And my partners and I are committed to quality and best practice and to having a little fun along the way. So thank you very much for letting me come tell the story. And